The banks have really three things working for them. One is they underperformed last year, so they're a value part of the market. So they're actually a value trade here. They're probably one or two multiples below where they should be, just because of the fear of recession kind of crept into these valuations and is starting to kind of be lifted, but hadn't come completely out. On the other side, what you have is capital. We're getting capital announcements. We'll get big capital announcements this year, this month. And that'll get through the CCAR, and then the super regional banks will actually be able to be out of CCAR, but we'll get capital, which gives you a 10% return, cash return from these investments that are a value place. And then lastly, credit stable. So we don't see really the recession or the pressure on credit. And as long as we have that, this is a good runway and a good kind of entry point again for these banks relative to the rest of the market.
So things look okay macro-wise. I mean, in terms of loan growth and credit quality and everything else. We're not always hearing that. I thought loan growth was kind of weak or something. I mean, it's about where you think it should be or a little better?
It is. Actually, loan growth has been pretty steady. It's not been stellar throughout this whole recovery and expansion. So we've had slow loan growth. We've always seemed like some kind of uncertainty that we're facing that has held the businesses back from really kind of pushing ahead. But what that's done is put a governor on the growth so that this will be a much longer expansion than what we've seen in the past. We just hadn't been able to ever really catch that momentum and really kind of get into, lose the discipline, get overextended. We really hadn't seen much of that so far this cycle.
I mean, for bankers that have been waiting for, a steeper yield curve for, their classic business to come back, it's just never coming back to that extent. But if the Fed goes lower on the short end, does it steepen a little so they do a little bit better?
Right now, what we think is that the Fed is just kind of in a pause mode. In the past, when they've overextended, they've actually pushed the Fed funds rate above inflation and real growth. So they're above nominal growth when you start to see that real kind of pressure. Right now, they're just right with inflation. So if you look at it just pausing right here, the yield curve is inverted, but that's really because of other anomalies that are in the market. We think this will all kind of settle down. We'll see the yield curve just kind of flatten out. And yes, we're just going to be here for a while. This isn't a bad environment. Deposit rates will start to stabilize. And we still are, again, 100 basis points higher than what we were at the trough. So there's some loans and some securities that can still reprice to these higher levels in the back half of the year.
But your two favorites are what? Citigroup and Bank America?
Actually, no.
No?
We would rotate into the super regional banks. We like Citizens Financial Group, and we like, if you look at kind of another kind of sleeper would be Regions Financial. It got hit last year. It has the risk from the last recession that they've de-risked, and they've also limited their asset sensitivity. So they've repositioned banks significantly, and we think that those two are really good values at this point right now.
But none of the money. So what about Goldman? You think Goldman's strategy is Solomon's new strategy is going to pay off?
Out of the money center banks that you were mentioning, we do think Goldman represents one of the best values, but it's a long-term kind of turnaround trade. So if you look at the large cap banks, you've got three turnaround longer-term investments. You've got Goldman, you've got Wells Fargo, and you've got State Street, all of which are high-quality institutions that over time should do well for investors, but not in the short run, just longer term.